Ladies and gentlemen, welcome to the Invest in Malaysia podcast.
Mont Kiara. You know, it's got to be one of Kuala Lumpur's most watched, but also one of its most misunderstood property markets. So we've gone deep into the latest reports to pull out one single thing for you, a clear, actionable investment plan for 2026. Let's jump right in. So right off the bat, we're hit with this huge puzzle. You've got developers launching these shiny new towers with price tags that are breaking records. But if you look at the data, the smart money, the real value, seems to be hiding somewhere else. So what's really going on here? You know, the entire market right now is basically a tug of war between these two ideas. On one side, you have the new launch hype. It's tempting, right? Brand new, the latest designs, but it comes with risks like construction delays and a price that already has all the future growth priced in. But on the other side, you've got the subsale reality. We're talking about existing properties, they have a proven track record, you can get a tenant in there tomorrow, and there's this price gap, which honestly is the key to this whole thing. Okay, so this is the most important takeaway. You absolutely cannot look at Mont Kiara as one single, unified market anymore. It just doesn't work that way. To really get it, you have to see it for what it is, a market that has literally split into two different tiers. Now, if you just glance at the headlines, you'll see this number, 735 ringgit per square foot. And you might think, okay, looks pretty stable, maybe a bit boring. But that number, well, it's basically an illusion. It's an average that completely masks the incredibly dynamic story happening just beneath the surface. Right? Because while that average number is just kind of plodding along, the top end of the market is absolutely taking off. It's pulling away from everything else. We're seeing this massive gap open up between the A-plus buildings and, well, the rest of the pack. And boom, this slide says it all. Just look at Residensi 22, a true blue-chip property. Its median price is almost 1,140 ringgit per square foot. That is more than 50% higher than the market average we just saw. Seriously, that's not just a gap, that's a chasm. So what's causing this? Well, it's a classic economic trend called the flight to quality. Think about it, when things feel a bit uncertain, people don't just buy any old thing. They actively hunt down the best of the best managed, the best located, the most solid properties. And for that peace of mind, for that prestige, they are absolutely willing to pay a premium. All right, so let's dig into the proof behind this split. We're going to put the investment case for a brand new launch head-to-head with the value that's just sitting there waiting in the resale market. The main reason for this is actually pretty simple economics. The price of everything, steel, cement, labor, it's all gone way up. So for a developer to make any money today, they have to launch at over 1,100 ringgit per square foot. And this has created what we call a pricing disconnect, where really high-quality existing buildings, the ones built when costs were lower, suddenly look like an unbelievable bargain. Okay, let's look at the market leader, Residensi 22. This is the gold standard for modern luxury in the area. It's getting that super high price per square foot we saw, and look at the growth. Over 11% capital growth in just the last year. This is a perfect example of where all that flight to quality money's going. But now, here's the really interesting part, the value play. You have Seni Mont Kiara. It's just as prestigious, maybe a little older, but it's trading at only 856 ringgit per square foot. It's still posting fantastic growth, over 8%, but it gives you this huge discount compared to a brand new launch. For an investor, that gap right there, that's pure potential. And then you've got what's coming next, the new wave, with projects like Jalan Kiara. And they're smart. They're not just building another condo, they're targeting what people want now. It's a certified green building, it's pet-friendly, and this is huge. The developer is actually widening the road to fix a known traffic problem. They're not just selling apartments, they're selling solutions. Now, everything we've talked about so far, that's all happening before the arrival of what could be the single biggest catalyst in Mont Kiara's entire history. There is a massive infrastructure boom just around the corner. And this is it, the game changer, the MRT3 Circle Line. You know, for decades, Mont Kiara's biggest Achilles heel was that it was basically an island, completely cut off from the rail network. You had to have a car. The MRT3 is going to change everything. It finally plugs Mont Kiara into the rest of the Kuala Lumpur transit grid. So, what's that going to do to prices? Well, if you look at data from cities all over the world, the answer is crystal clear. Properties that are within walking distance of a new train station consistently get a transit premium. We're talking a value bump of 10, even 15% over places that are further away. This isn't just a guess, it's a predictable structural shift in value that's coming. And it's not even just the MRT. You've got these other, smaller, but still important, catalysts, all adding to the momentum. Widening Jalan Kiara 3 will ease one of the worst traffic spots. The arrival of a big name like the Pavilion brand adds a whole new level of lifestyle and prestige. And there's this growing green premium for sustainable buildings. Each of these things just adds another layer of value to the area. So let's put it all together. What does this all mean for you as an investor looking ahead to 2026? Well, based on all this data, here's the actionable playbook.
Okay, so the strategy really boils down to 4 key moves. Number 1, go for the family-sized units. That's where demand is strongest and supply is tightest. Number 2, focus on freehold titles. They're getting rarer, and that scarcity is going to mean a premium down the road. Number 3, exploit that subsale arbitrage we talked about. That price gap between existing quality and new launches, that's your sweet spot. And number 4, position your money near the upcoming MRT stations to ride that infrastructure wave.
Probably the best way to frame this whole evolution comes from this quote in the source report. It says Mont Kiara is no longer just a place for speculation. It's maturing into a stable, blue-chip residential district, kind of like London's Kensington or Singapore's Holland Village. And that really is the final thought here. The market is clearly growing up. It's entering a new chapter, one that's going to be driven by real quality and real infrastructure. And so the only question left to ask is, are you positioned to be a part of it?